Good morning and welcome to today's webinar hosted by Spheria Asset Management. My name is Gerald Williston and I'm a Director of Distribution at Pinnacle Investment Management, an equity partner of Spheria's. Today, we are going to be talking about the remarkably different market conditions Spheria are seeing, discuss why the team are excited about current opportunities, and show you how Spheria's process differs, providing a unique and distinct portfolio from the crowd. For a long time, investors and advisors have been turning to the small and micro-cap sector for the prospect of greater returns than large caps. But with that comes higher risk that can eventuate from the sector. So it is important to focus on fundamentals, including strong balance sheets and strong free cash flow generation. As an investment manager who focuses on strong free cash flow businesses, it is interesting to note that according to a research conducted by Morgan Stanley's Australian Equity Strategy Team, investing in high cash flow yielding small cap stocks over the last 25 years has produced returns circa 2 times that of the small cap index. However, over the last 5 years has been a headwind as glamour stocks have run, much the same as pre-GFC. As the GFC showed, the highest alpha from high cash flow yielding stocks in the small cap market often happens after a crisis and can last for many years. Could a post-COVID environment be the start of the next era of cash flow yield investing? This is how Spheria feel about the space and why they're excited to share their insights in today's webinar. Let me pass it over to today's presenters, Matthew Booker and Marcus Burns, founders and portfolio managers at Spheria with over 40 years experience in the industry. Please send in questions throughout the webinar as we will have time for Q&A at the end. Over to you, Matt and Marcus.
All right, thank you, Jed. So it's Marcus Burns here, one of the co-founders of Spheria, just kicking off the presentation. And as always, we like to start with a quote to kind of frame our thinking and frame the presentation. And we just decided to choose a basic Peter Lynch quote here, just to remind the audience and ourselves of all the fundamentals that we look at and we think will drive share prices long term. And amongst the many quotable quotes from Peter Lynch, this is one that jumped out at me, which was: the basic story remains simple and never ending. Stocks aren't lottery tickets. There's a company attached to every share, and that's something that the team tries to remember when we're looking at the market and analysing, the constant gyrations of share prices. We believe that fundamentals long-term do matter, and this webinar will just take you through a couple of observations around the market we're seeing as a team. Talk about a couple of macro drivers that are shaping our views, and then talk about a couple of stock examples that we feel really demonstrate what we're seeing. Where we're seeing good opportunities currently, and then put that into context of the portfolio.
Thanks, Marcus. Good morning, everyone. It's good to be back talking. It's been we haven't had a webinar since April, and this chart's interesting because it has been a crazy period, and you can see it in this chart just with the declines that we saw in the indexes in Australia. So I've got the top 100 there in red, and I've got the small cap index in blue and the micro cap index in green. You can see the micro cap index fell, 50% from the start of the year to the bottom there. It's an incredible fall. And you saw sharp falls across all equity markets globally as well. But the micro cap and small cap indexes were hit very hard. We saw that as an opportunity. We were deploying into that market, although it was difficult. There were some outflows from retail clients, but we did see inflows from institutional clients. So slightly different views out there in the market. Obviously, we've had that big bounce out. The bounce out, however, the mechanics of that have been obviously something that we didn't expect. There was the value rally early. Sort of the reopening rally, but it was followed by what we perceive as a very speculative rally in growth assets, and you're seeing bubbles being formed, actually expanded, I would say, across many sectors and stocks. So it has been quite a narrow rally after that value rally, and that's made it quite difficult to outperform. However, as Marcus discussed, we own some great businesses that are currently, we feel are being given away by the market just because they're not popular. They don't have the hype, but they generate great cash flow and quite sustainable cash flow at very low multiples at the moment.
That's right. And just to Matt's point, there's a lot of stocks, particularly down the market cap spectrum, that are frankly, putting politely, less promotional in terms of how they operate their businesses. They spend more time focused on the business and less time focused on marketing themselves to the marketplace. And we feel that a few of the names that we own that are actually very fundamentally strong businesses are kind of fall into that camp. Can you go to the next slide, please, Jed? So just to frame a bit of that commentary that we sort of touched on with regards to central banks and the stimulatory environment that we're seeing, we thought it would be worthwhile just going back and comparing Australia and looking at what our central bank has done over here compared to, say, the US and some of the major foreign Federal Reserve banks. And it's interesting. I think there's been a lot of commentary in the press, particularly domestically, but also internationally, around the scope of monetary stimulus provided by the Fed in the US and by the ECB in Europe. But what hasn't really been picked up on necessarily as much has been the amount of stimulation given by the RBA in Australia. And you can see that in these two charts here. So the M1 supply is the narrowest form of money. It's basically the amount of cash that is effectively being created to circulate in the economy by the central bank. And you can see this is a 20-year chart showing Australia. And the last 12 months, this data is to the end of May, we've increased our money supply by a whopping 38%, or pretty close to $350 billion in Australia. It's a massive, massive amount. By contrast, the US, which has been talked about a lot, has increased by 33.5%, so less than what we've done. And interestingly, over the very long term, if you just tab forward the next slide, Jed. Can you talk? Yeah, thanks. Yeah, over the very long term. So this is the money supply base of the central banks of Australia, China, the US, the Eurozone, and Japan, just for contrast. You can see that we've almost topped the charts. Obviously, China's at the top because it had a very fast-growing economy of a very small base back in 2000, or 2003, sorry, when this chart goes back to. But Australia's, also been an incredibly accommodative environment with money supply, and we've consistently stimulated the economy with liquidity through the whole period of time. And I think what it is doing is that it is actually encouraging people to seek risk assets. We remain constructive on equities for that basis, that it's a good place to be when central banks are producing money at this kind of rate of supply. What as Matt said before, we struggle with a little bit is the overextension on some areas where we do see bubbles forming in the high growth areas of the marketplace, particularly the tech stocks, some of the biotech stocks, and things with very little fundamental basis to support them. Perversely, there's an equally good opportunity on the other side of that, where people have used real businesses to kind of fund the furore into some of those more speculative names.
Okay, Jed, can you move to the next slide, please? So obviously the manifestation of all this monetary printing and just outright fear in the population globally has been the gold prices obviously rallied significantly. It's going through a blow-off phase, and the stocks behind that are rallying quite significantly. They've had a massive bounce in recent periods. The fear has been created. I suppose that the perceived safety is in gold at the moment. The question is, we've seen these cycles before, we've seen these bubbles form, and generally they don't end well. However, you look back at 2012, and what happened back then was you had QE1 and QE2 coming out of the GFC, and you saw the gold price rally on the back of the stimulus. So that was over several years that occurred. What led to the fall was a lack of QE3. There was no real QE3, and the gold price fell pretty considerably. The economy's recovered, and obviously the gold price fell. So at the moment, it's hard to foresee the economy's recovering quickly when we've locked down most of them. However, there is always left field events and long tail events occur, and the eventuation of a vaccine, or people just getting on with business, as you've seen in some countries, could see that gold price retrace. So it is a risky place to go. A lot of the gold producers are quite marginal generally at a lower gold price. They're just not economic. But currently, even the most marginal mines are making a lot of money. So it has been an issue for us. We have been underweight gold. We do have some exposure and some derivative exposure through mining services, but that has affected the portfolio's relative performance as well. Now, if we move on to the next slide, and you're seeing similar trends here. We've taken some extracts from a research house. And any way you cut it, you can look at, the share market indices in the US market, and you can see that we are at a peak again in terms of growth versus value. There's a number of measures there that you can see. We're seeing the same manifestation here in the domestic market. Obviously, we don't have the FANGs, but we have the waxes, and we have a number of sectors, I suppose, that are riding the coattails of this trend at the moment. The problem with this is the whole market, or big chunks of the market, are following the same trade. So it's become very crowded. And if there is some breakage or change in paradigm, you're going to see a big shift, and it'll happen quickly. We've been saying this for a while, but it will happen quickly, and you can see that we're at very much extremes at the moment. So I would just be cautious on that thematic. I think when it comes to an end, it will probably end in tears. I don't know if Marcus wants to add something on that.
No, I think it's a very good point, Matt. And we Matt and I and the team always think it's good to blend a bit of so-called growth and so-called value into how we think and how we invest. But we still think valuation matters, and we do try to value stocks even though they're growth companies and buy them at attractive valuations. And I guess the thing we've been harping on about for a little while is just the extension of, frankly, concept stocks, or businesses we would have considered previously as concept stocks, where they might have a revenue, they exist, they're still burning a ton of cash and haven't really proven the business model can survive without endlessly retapping the marketplace to raise money. But there are a number of those businesses that are now well over $1.5 billion to $2 billion market cap, excluding the BNPL and buy now pay later space. That really just incredibly speculative in our view, based on there's a lot of free rein being given to the management teams to try and prove up business models that haven't proven to be profitable yet.
No, it's incredible circumstances. Marcus said the valuations on some of these names are just surreal. And then we move to the other end of the spectrum. And Jed, do you want to move to the next slide? Just looking at a company like A2B, which is formerly the cab charge business. Clearly, the share price has been under a lot of pressure. We are a substantial shareholder in A2B. And what we point out is the valuation here is just at an abysmally low point. You've got $24 million of cash in the business. Its market cap is about 100. It's got a head office, like its property, its head office, its depot in Sydney's and Alexandria. It's very valuable. It could be worth anywhere from $50 to $100 million. Cash and property alone covers the market cap of this business. It's incredible. And then if you look up the top left chart, you can see the cash flow. Okay, the cash flow has come down a lot since the halcyon periods. A lot of that was due to the charge changing in terms of the credit card surcharge going from 11% to 5% effectively. And so you've seen a big reduction in that. Obviously, there's more competition in the space, but there is a very good management team in there at the moment. They're getting the technology right. They're really turning around how taxis and cab drivers are perceived. They've really improved things, and they're starting to sustain their market share. We believe they can grow the business. They're embedding a lot of good technology in the business, and they're also extending that payments technology into other sectors. So this is not just a one-trick pony here. So your downside risk at the moment is minimal. They've got property and cash, as I said, and the upside is, obviously they start to grow their market share because they're doing much better on that front and extending it out as well into the payment system. The company's trading on about 3 to 4 times normalized EV to EBIT. So that's basically a 25, 30, 33% payback sort of story here. So it's one we like. Obviously, there's a number of these microcap stories out there and a number of these actual small cap stories out there that are just not getting any interest at the moment. And, we think we can make significant amounts of money out of these companies. Obviously, the market's not paying them heed at the moment, but it can change quickly. And I think that's what we'll see at some point. I think Marcus will talk about supply network next.
Just before we go on, Jed, just to add to Matt's point, sorry, go back to one slide. Sorry to jump around here, but just to Matt's point, I mean, this business made $20 million of EBIT last year, and first half EBIT grew organically in the mid-single digits, so it was back into modest growth. Clearly, the second half is being impacted by COVID. But we'd also flag that cab numbers are starting to grow again in Victoria, obviously pre the COVID outbreak, as they deregulated the market back down there. And the 1-3 cabs network is growing, and it's a unified brand now across the country. And the technology they've learned from the from Uber, etc., and copied that app. And so they've got comparable technology in many cases, as Matt said, and cabs we think will be here to stay. And this business yields 7-8% fully franked dividend yield on a normalised basis. So just ridiculously cheap, and no one covers it on the sell side.
And as Marcus said, they're actually putting their foot down at the moment, and they're spending a lot of money on advertising. You've probably seen it on the out-of-home boards as you've walked around, and on TV, and on social media. So they're really getting out there and getting on the front foot and turning around that perception of the business. And in terms of cleanliness and safety, I think that everyone would subscribe to the view that things have improved with that business.
100%. Just another stock we own in the microcaps and a little bit in the small cap funds is Supply Network. It's not a well-known brand. But it is a very well-run business. It supplies aftermarket truck and bus parts via a brand called Multispares in Australia and New Zealand. It has an incredibly long history of organic rollout of their warehouses. So there's now 21 locations, 16 in Australia, 5 in New Zealand, and you can see from that left-hand chart the return metrics. So this is return on capital is incredibly good, north of 30%. And despite the fact that they've been redeploying fairly substantial capital into expanding the business over the last 10 years, returns have maintained that very high rate. So they are getting incremental returns equal to the existing book value, return on capital within the group, which is a very positive sign. And over the last 10 years, they've compounded the revenue growth at 11 to 12%. All of that is organic. I mean, there's been almost no acquisitions in what they've done. And EBIT's expanded 17% CAGR over that period of time. So that's normally would be re-rated. If it was a small cap business, it would be re-rated to incredibly lofty multiples. However, you can buy this business on 11 times EBIT looking forward in FY21. They had a very positive trading update recently. They postponed the dividend as everyone else did back in March, April. But then they reinstated the dividend as they saw trading continue to be pretty strong and cash came in. So very resilient business, incredibly ably run, and just not really on the radar screen, as I think there's one broker covering it, and not very promotional, unlike many other stocks in the space. These guys are just going about their business, running their business well, and generating great returns, great cash flow, and a very consistent growing dividend yield. So we're finding these sort of names that exist in the marketplace that are just kind of ignored, and we think they're excellent companies.
Yeah, it's a growth company at a value multiple, and we've got a number of these type of companies in the portfolio, and we know over time we're going to make money out of them. But at the moment, as we've said, that there's just very little interest in them, which is a good thing for people that own them, because eventually they will re-rate, as Marcus said.
Next slide.
Yeah, so what we've seen, I guess, and what we talked about is some bubbles out there in fintech growth. The economy will reopen. It is reopening. Obviously, it's a bit stop-start at the moment, but there will be a recovery in cyclicals, and we believe smaller caps will benefit from that as well. Look, central banks around the world will continue to debase cash, and that looks good for gold. However, you just need to be cautious, because there's a lot of speculative behaviour in that space, and if you do see some retracement in the gold price, a lot of these mines are not economic at lower prices, so you just need to be careful on that front. The equation, I suppose, the value equation can change really quickly on that front. What we're seeing in the small cap, micro cap space has been some, there's definitely M&A activity starting to brew again. We saw it with Village Roadshow. We're a substantial shareholder in that. Obviously, it fell a lot, but there is a takeover that has been tabled there. Well, it's in the process of being tabled. We think you'll see more takeover activity across smalls and micros, and perhaps into mid caps as well. We just think there's a lot of companies here that are trading cheaply. We know that the corporate management teams out there, a lot are still working from home. They've got investment bankers in their ear, it's hard to get growth. The best way to do it at the moment, and given funding is cheap, is to actually buy it. So you're going to see takeover activity through the market, and we think we'll be a beneficiary of that. We're not, we don't directly position for that, but we do a lot of work on strategic position of companies in their sectors. And, the corporates and bankers do the same type of work. Look, the markets will, we believe, continue to recover over time. We think this is still a good opportunity to get involved. As we've said, we're positioned probably more in the value side still. Obviously, we did buy some more growth type assets at the bottom. However, we do still have that value tilt, and we think we'll benefit from that going forward. There have been a number of recaps. There will probably be a second wave of recaps across the board. Obviously, with the lockdowns that we're seeing, this has affected some of the companies again. So there's potential for more capital raisings, and some of them may be attractive to us. So we'll just keep an eye open from that. But yeah, we think it's time to still be constructive, particularly on the value elements of the share market, and small cap and micro cap. At this point, there's a big chunk of that particular segment of the market that looks very attractive. Okay, should we open up to questions?
Yeah, happy to open up to questions, and let's want to cover off on these top 10. Otherwise, we'll keep them in the background. We have had some questions that's come along as well. I'll start with one of them. It feels like momentum is a huge factor in small caps at the moment, and everyone has a fear of missing out, for example, Afterpay. Has this always been, and what change do we need in markets to bring it back towards fundamentals, i.e. strong balance sheets, free cash generation?
Yeah. Okay, I'll have a crack at that, Matt, and feel free to jump in, obviously. But yeah, I think momentum is as a factor driving stock prices is definitely come more to the fore in the last couple of years. It's always been an issue in micro caps and small caps, but it's become a bigger issue. I think retail investors have also added to that sort of that effect, and obviously the move to passive investing has also accelerated that a little bit to some extent. As as stocks gain share price momentum, they enter into indices and get passive buying as well. So a lot of the factors have sort of accelerated that impact. What derails that and what causes a sort of reversion, if you like, to more valuation style investing? There are a number of scenarios you could paint. Obviously, interest rates rising would be one of those. That does seem to be a long way off, to be honest, at the moment. But everything we're doing around the world at the moment is fundamentally inflationary. Gold price going up is one of those things. Printing money is, if economies recover, we might see inflation recover. Alternatively, perceptions and views change, and if we do see, as Matt and I expect, a material re-emergence of M&A and corporate activity, particularly in the lower market cap spectrum where we're seeing incredible opportunities, that might cause a massive rethink and more broker interest and attention, which is just completely lacked currently. Matt, do you want to add to that?
No, I was happy with that. Probably move on to the next question.
Next question that's come in: are there any sectors Spheria avoid or are particularly cautious of?
There's nothing we avoid, and we've got exposure to pretty much every sector. I mean, we do own gold companies. We've owned them for a while now. We're underweight that sector. It is very difficult finding, long duration gold mines in microcap and smalls. They tend to be very short duration type assets, but they get priced for long duration. So there's nothing we really avoid as such. Can you think of anything, Marcus?
No, I think we certain characteristics we avoid rather than sectors. So we avoid businesses that we think are fundamentally weak, competitively challenged. We avoid businesses that haven't really proven their business model. But we'll look at gold, as Matt said. We'll look at mining services. We'll look at energy. I guess to Matt's point on gold, they do have very short mine lives. Obviously, the gold price increasing or decreasing can materially change their JORC resources, because at $2,000 an ounce, a lot more ground becomes economic. At $1,000 an ounce, a lot less ground becomes economic. And of course, this is the operating risk as well, which people forget. I mean, they have quarterly updates And the variability in production is quite dramatic on many sites, because you've got grade differentials, you've got ground control, you've got rain. They're all in remote locations, so a lot of varying factors can materially throw around the earnings and cash flow short term, which means the stocks end up getting quite busy, quite noisy in terms of their trading. So we're conscious of the gold backdrop. But to Matt's point, long term, they haven't been a great sector to be invested in. So we are fairly cautious on that sector.
Okay, another question. There is a lot of talk at the moment about the rising unemployment rate, and it is commonly known that during tougher economic conditions, it's felt by smaller businesses. Are there any insights you can share on businesses that are performing well, or one that could have significant headwinds?
That's a pretty broad question. Have you got an answer, Marcus?
I do. I'm not sure it's a great one. I think look, I think COVID has been an incredibly uneven impact on the economy. I'm stating the obvious here, but unlike say the GFC, which again it was also uneven, but at the same time the macroeconomic effect was broadly felt by everyone, because you couldn't get liquidity. This time, central banks have the playbook from last time and have just absolutely flooded the world with liquidity and confidence, and rates are super low. So, raising money and trade finance, etc., is not an issue for any company as far as we've come across. There was some short-term impacts with supply chain, obviously with China, but that seems to have resolved itself pretty quickly. So, I'll just say that some things have seen a very big short-term benefit. For example, online businesses have had a massive short-term hit, a positive hit. Some of those things are structural, but there's been a big jump to those things. We've also seen JobKeeper positively impact many businesses short term, and there's two impacts there. One is obviously the cost bases get absorbed by JobKeeper if they've had that decrease in revenue by 30+% in March. But against that, a lot of people have had sort of windfall earnings for not doing much work at all, and it's very easy to spend money that you haven't earned. And if you've got kids, you know that. So I think the cash economy and the spending by consumers has been incredibly propped up by JobKeeper. So I'm not giving you a clear answer, but these results will be very noisy, we feel, with some cost bases being absorbed. Some businesses seeing a very big stimulation from the money drop and JobKeeper allowances being handed out to people, and some have fallen back. So I think some of those structural issues have probably been accelerated by COVID, and some are cyclical that we wouldn't want to capitalize on. So we try to look through the noise and pick up stocks that we think are massively overpricing the short-term risk. Some of the travel and leisure names we would flag as being in that camp. Obviously we do think that eventually we'll learn to live with COVID, and there'll be some kind of vaccine or mitigating event. Against that, short-term massive revenue growth that some of the online players appear to be overdone to us. So bit of a long answer, but that's probably my view on that.
That's fine. We've probably got time for one more question, a little more cutting to it. So the question is, we've obviously seen performance in both small and micro cap companies funds be tougher of late. Can you give us an idea of how the funds have performed in both absolute terms and relative terms across different timeframes, and why you'll feel like you're positioned to perform well going forward?
Look, Jed, I'll take that. It's been very difficult. I think over short and long-term timeframes, we've struggled against the index or indices. So it has been very difficult. Valuation, for the market seems to have gone out the window. It's being driven by speculation, quantitative money and passive money. People are just playing what's popular. It's almost bitter and twisted out there, views and jaundiced views towards anything with a valuation. So it's made it very difficult. We do own some growth companies. They have helped, I suppose, keep up to a degree. But just the way that anything with a valuation's been roughly run over has just been unbelievable in the last probably three and a half years now. And, it's probably the longest stretch that, I suppose valuation hasn't mattered. Over longer periods, value does work. You do get better returns out of value. It's proven. There's been studies done. But in the last 3.5 years or so, it has been definitely a growth-driven market. When that changes, I'm not sure, but we think we're positioned for it. If people want to pile into growth companies at the moment where valuations, well, the word valuation is not even used, they can do that. I think most of the market has moved to that, and that crowding effect could be quite dangerous. Maybe it keeps winning, I don't know. But, from the way we see it, valuation does matter. If you don't think it matters, well, you probably, you're on a different page to us.
It's probably not called investing to that point. I mean, if you go back long enough, the team has a very good record of outperforming markets, and I think the super low interest rate environment / negative real interest rate environment has been a very distortionary effect in terms of how capital is being allocated by management and by investors. And that's something that I think Matt and I struggle with a little bit. We do think discount rates matter, and $1 today is worth more than $1 tomorrow. However, the market appears to be pricing the fact that $1 tomorrow is worth more than $1 today, which just doesn't make any sense to us. So we're not immune to, we're not completely unaware of macroeconomic environment clearly, but we try to manage as best we can through that and blend the portfolio with some reasonably priced growth names to the extent they exist, and some really attractive cash flow generating cheaper stocks that we think are fundamentally great businesses, just have been unloved temporarily. So we're probably we've got the most latent value in the portfolio we've had for a long time, man. I'd say. Would you agree with that?
Yeah, and to be honest, we've got to stick to our beliefs and our philosophies, and if we change, that would be the end of us. So we're not going to change the way we are. I think we've got a good blend. Yes, it's been difficult, but things will improve. As Marcus said, there's just so much valuation opportunity in our portfolio in the market that there's just no interest. But that changes. Things go in and out of fashion. We see that every day in our, just in everyday living. So things will change and things will get better. You just got to stay positive. Let's not get negative, bitter and all that sort of stuff, and just stay positive and optimistic. And if you keep that temperament, whether it's in life or in investing, I think you'll do well over the long term. But it has been very, very difficult few years for us at Spheria. As Marcus said, if you look at our extended track record, including Schroders and before that, we've done really well, but it has been a tough few years for us, and we acknowledge that.
Thank you, Matt.
I would say that the team is working. Go on, Jed. Sorry.
No, you go, Matt. You go.
I just finished it. Just to add to Matt's point, I think the team is still working really well, and we are getting through a lot of research. The team is actually working as tight as ever, and I think finding good opportunities. So we remain fundamentally positive around the portfolios, albeit the short-term performance hasn't been maybe as stellar as we would have liked, clearly. Yeah.
Thank you. Look, guys, I'm aware we've got now, and I'm conscious of everyone's time. I just want to reiterate the ratings from research houses are still very strong. They have high conviction in the team as well, which shows support and belief in Spheria as a manager over long time frames and their philosophy and investment method. Just quickly touching on the disclaimers quickly there at the end. But in closing, what I'd like to do is thank everyone who dialed in for their time today. We do greatly appreciate you taking the time to listen to today's webinar. If you have any further questions or would like to know more about Spheria, contact a member of the Pinnacle distribution team. Any questions that we did not get to either, we will send direct responses to you as well. So thank you for your time today. Much appreciated, and goodbye.
Thanks, Jed, and thanks, audience. Great being on.
Thank you. All the best.